So we also learned that the stockholder equity account, additional accounts are revenue and expenses. So we talk about that expenses are decrease in equity due to the cost of operation, and revenues are increase in equity from delivering goods or services to customers. So let's see that. So here, the equity account include common stock, retained earnings, dividend, revenues, and expenses. So the revenue will increase the stockholder equity, dividend will always decrease the stockholder equity, and expenses always decrease the stockholder equity. So now we can say that these are the rules of debit and credit. We just have two exceptions here. When it comes to expenses and dividend, when it comes to expenses and dividend, the rule is there is exception. So we know that when asset increase debit, when asset decrease credit. We also learned that when liability increase credit, liability decrease debit. We already know that when the common stock, which is a part of shareholder equity increase credit, decrease debit. Retained earning is also part of stockholder equity. Stockholder equity increases credit, stockholder equity decreases debit. Revenue is a part of stockholder equity. Stockholder equity increases credit, stockholder equity decreases debit. But there is two exception, which is dividend and expense. So they are not part of assets, but their treatment regarding the rule of debit and credit is the same. But remember, these two are not assets. So the dividends are stockholder equity. So when stockholder equity increases, it should be credit. But when dividend increase, it is debit. And dividend decrease, it means credit. Expense increase is a part of stockholder equity. It is debited. And when expense decrease, it is credit. So there are rules that I am just going to write it here. That is, if assets increase debit, which kind of asset, which belongs to, which account belongs to, or what, it doesn't matter. The name of the account, all the matter is that its category. If its category is asset category, then if it increases the assets, the debit. If it decreases the asset, credit. Liabilities plus honor equity. If the account increases either of the account, credit, decreases debit. The stockholder equity, like I just said, increase, which means credit, decrease means debit. The exception is with respect to few accounts, dividend and expense. The treatment is opposite like assets, but these are not a part of assets. So dividend basically increase mean debit, expense increase mean debit, dividend decrease mean credit, expense decrease mean credit. Let's start off with learning objective 5, which is record, which means journalize and post transaction in the books. So first we're going to learn about journalize. So let's talk about that. So journal means chronological record of transaction, which means date wise. First transaction will come first, last will come the last. So there are three steps that how we gonna journalize the entry. First, that the transaction affect which account. Second, determine their which sides debit side or credit side, right? Which means increase or decrease. Third, you record it, and recording has some kind of norms or traditions. We're gonna learn that. So we have the previous example, Friday's auto service. So the transaction is that business receive 50,000 cash and issue stock, right? So now think in terms of which accounts they affect. So this transaction will affect cash account and common stock account, right? Cash is a part of cash is the account for asset, and common stock is the account for owner's equity or shareholder equity, right? So think about that. When business receive cash, asset increase, and company issue stock also increase. So cash increase mean cash is increased, cash is the asset increase mean debit, right? And owner's equity increase mean credit. It means both cash and common stock increases. While when we generalize this entry, the norm is that we have to write it in debit and credit. How we pronounce it? Debit to credit. So how we're gonna write it? First, we write debit account. And what is the debit account? Cash. So cash account is debit 50,000, and common stock is credit 50,000. See, and this transaction is balance, right? So if you are noticing, I just included a space here. And how we gonna pronounce this journal entry? Cash to common stock, right? And when we talk about cash, it means it's automatically means that it is debit and common stock, because this is a part after coming to. So it means we are talking about this credit, right? So how we gonna pronounce this cash to common stock? When you say to this uh, cash to common stock to a accountant, he automatically know that we are talking about cash is debit and common stock is credit. The journal is a chronological record of all companies' transactions listed by the date, but the journal does not indicate how much cash or account receivable the business has. So the ledger is basically a grouping of all the T accounts with their balances. For example, a balance of the cash T account shows how much cash the business has. The balance of account receivable shows how much the amount due from the customer, and the balance of account payable here will show that how much is the amount you have to pay to your supplier, and so on, right? So if we copy the information from the journal, remember this is the journal, GOURNAL, this is journal, and how we're gonna post it into the ledger. So this act is called posting, right? So you make a T account, this is cash, this is common stock. If you do not write this debit credit or debit, it automatically means that the left side is debit, right side is credit. So how are we going to post it? Since in this one transaction, right, we're talking about the transaction, so date 1 April, so you can write it down here, April 1. And why I write it here? Because this is a debit side, so just write it down 50,000 here. And in April 1, Why I write 50,000 here? Because this is common stock and 50,000 is credit side, so I just write it on the credit side, right? So let's see that here it is, right? This 50,000 came here on the debit side, on the credit side. Why there is no CR here or DR here? Because it's automatically, we assume that now you know all the information regarding the P account, that the left side is called debit, right side is called credit. Even if you don't write the word here, the accountants automatically means that right side is credit, left side is debit. So regarding the flow of accounting data, so flow of accounting data is follows as transaction occurred. When transaction occurred, it is analyzed. What do we mean by analyzed? That it hit which accounts, and then we entered into a journal using our journal method, and then we post it to a ledger. So we use posting method, in which the balance is written on the T account. If the T account balance is credit, it will be written on the credit side. If account is debited, then it will be written on the left side, on the debit side.